So what if the biggest thing stopping you from buying your first investment property isn't money at all? So today's episode is going to completely change the way you think about financing investment properties. We're going to talk about creative financing in a conventional way. So HELOCs, a cash out refinance, HELOans, all of the things you can do with conventional lending.
This is Branching Out, where real estate meets real life. Real conversations about building steady, meaningful wealth through real estate, helping everyday professionals gain clarity, build confidence, and move forward with a plan they can trust.
To explain this all to us today, I have my friend and expert lender, Reanna Walls.
Hello, hello.
Thank you so much for being with us today. I haven't seen you in so long. Last time I saw you, we did this for your business.
Yes, we sure did. And I was at my old office, a different company I was with.
Yeah, for sure. All right, so that's a good segue. So what are you doing now?
So right now, I kind of basically started up my own thing. I have a DBA underneath a larger company, so I'm more or less just working for myself, doing everything entirely myself. I no longer work with a team at all. I do everything start to finish, which I think has been very impactful for clients because I'm the only one that they speak with. There's no staff that I hand them off to, no processor, nothing like that. So I only take on about 3 to 5 clients a month. That way I can be very hands-on and make sure that they're taken care of throughout the transaction, that there's no lack of service or anything like that. Primarily, I've been working with a lot of primary home buyers and cash out refinances and home equity lines of credit and things like that, helping people access their equity so they can invest in other avenues.
Okay, that's awesome. So you're doing all of the underwriting and everything.
Not underwriting.
Okay.
You're still required to have an underwriter from the lender.
Okay.
But I'm doing everything myself as far as like, I used to previously have like a setup person who would like send out disclosures. I had a processor who would handle all the underwriting conditions, obtaining the documents from borrowers. And then I had a closing person who would handle the balancing and the actual closing of the transaction. Now I do all of that entirely myself. So it's just me and an underwriter basically.
Okay, awesome. What got you into lending?
Well, I was in banking for 8 years before mortgages. So the only thing I've ever known is finance since I was 19 years old, just numbers and money and helping people with their financial matters and improving their lives financially. So it's kind of a natural transition for me. What made me decide to go to mortgages and do the transition away from banking is just that I wanted to kind of have more control over my career and being able to make decisions on my own.
Awesome. And then you're predominantly working with primary home buyers. All right, awesome. So I love that because today we've had other lenders on here before where we've talked about all of the non-conventional lending. And that's all cool. And we'll talk about that today too. But I really want to focus on the conventional lending products that are out there. Because, you know, I'm a conservative investor. You're a conservative investor. We're not get rich quick. You all know that. So I just want to talk about other realistic ways for these investors to get money. I know a lot of people think you need a huge down payment, you need good credit, you need a ton of cash reserves, or you have to have multiple properties already. Partially true, but partially not. So let's first start talking about these cash out refinances because you said that is a big piece right now. You know, people either bought a house or refinanced in 2021 or 2020. So there's a ton of equity sitting in people's primary residences. So let's talk about a cash out refinance and what that looks like.
Yeah, so that's a great point of context is that a lot of people do have a ton of equity, especially in the Charlotte area. Home prices from 2019 to around 2022 went up on average about 50%. So there's a lot of people who are sitting on a lot of equity if they bought prior to 2020. And they also generally have really low interest rates, so they don't want to touch that first mortgage in a lot of cases. Those borrowers usually are best suited for a home equity line of credit. That way they can keep their first mortgage interest rate in the sub 3s, and they can take advantage of that additional equity. As well as it depends on the scenario because some home buyers or some homeowners have so much equity that their first mortgage is say only $100,000. and say their house is worth 500,000 or more. Those buyers, when the first mortgage is so low, even if they do have a 3% mortgage interest rate, if you're looking at accessing say 300,000 equity, and you're looking at a home equity line of credit for that 300,000 and keeping that 100,000 on the low interest rate just to keep that low interest rate, it may still make more sense for them to do a cash out refinance and get rid of that small mortgage that has a low interest rate, because the combined interest is lower when you look at it that way. So if you're looking at a home equity line of credit that has a 9% interest rate or higher, and your first mortgage is a 3%, but if you did a cash out refinance, you might be at a 6.5%. That difference of the interest rate for that bulk of the cash could make more sense for them to do a cash out refinance over a home equity line of credit. And a lot of those homeowners are using those funds for different investment properties or different types of investments.
Okay. So I've also heard, so can you explain what a home equity line of credit is, what a HELOC is?
Yeah.
It's thrown around. And then also HELOan is also thrown around. So explain what a HELOC is, and then compare it to a HELOan so you can get a difference.
So a home equity line of credit is a line of credit on the equity of your home. So a lot of them will go up to say 90% combined loan to value. That part actually throws a lot of people off as well, because some people might think that it's 90% of the available equity you have, but it's actually a combined loan to value. So say your house is, just for easy numbers, is worth $1 million. You would be able to go up to 900,000 as the combined loan to value if we're looking at 90%. So if your first mortgage is 500,000, that means you could take out a HELOC for 400,000. And so that allows them to access the difference of the equity up to that combined limit. And that kind of allows them the flexibility of using the funds anytime that they need. Depending on the program, all the programs have super different criteria and guidelines and limitations or restrictions. So some of them may require you to take out all of the money at closing, and then they ask you to not pay off the balance for, say, 6 months or pay down any of the principal. Some of them don't have any stipulations on that. So like usually home equities lines of credit that you pull from, say, a credit union or bank, usually those ones do not have any requirements of a draw at closing. So it's just an open line of credit just sitting there waiting for you to have an opportunity to use it or have a need to use it. And it's just an open line of credit. Think of it like a credit card. It's just there if you need it. And you usually aren't getting charged anything if you're not using it, or maybe you have like a very small annual fee of like $50.
Okay, that's cool. All right, so in contrast, what is a HELOan?
So the difference of a HELOan is mainly just that it's not a line of credit. So it's going to be a set dollar amount at closing, and you cannot take anything further from that. So on a HELOan, it's more like just a straight up second mortgage. It's very similar to a first mortgage in the sense that it's a flat dollar amount. So say you take out $100,000, that's all you're ever going to get from that HELOan. You cannot take anything additional. If you pay it down, the funds don't become available to you again. It's not a line of credit at all. It's just a one-time amount.
Oh, it's just a one-time thing. Oh, interesting.
And alternatively as well, I should have mentioned on a HELOC, they usually will have a draw period as well as an amortization period. And so what that means is it'll be, say, 3 or 5 years is usually the most common for HELOCs. I should say HELOC, home equity line of credit, it's kind of the abbreviation. There's usually a draw period. So it's usually 3 or 5 years that you're allowed to draw against it. And after that, it locks you out. You're no longer able to draw additional funds from it. And then there's usually an amortization period. And on the amortization period, it's usually going to be 25 or 15 years, depending on the full term of the loan. And then they basically amortize the remaining balance, and then that pays it off by the certain end of the term.
Okay. So then I would imagine then, just based kind of on what you said, that a HELOC is going to be a little bit of a higher interest rate because it's more like a credit card. And then it's variable. Okay. And then a HELOan, you're getting a lump sum at closing. And then you can do whatever you want with that. And then it's a set term to pay it off, probably at a lower interest rate, or?
Yes. A HELOan is usually going to be an interest rate that would be between a first mortgage and between a HELOC. So if a HELOCs are around 8 to 10% currently, and first mortgage is around 6 to 7.5% currently, usually a HELOan would maybe be 8%.
Oh, okay.
And it's fixed.
So, all right. So what kind of person would take out a HE loan? Like, what would they be doing versus the person who has a HELOC? Like, is there a different kind of people that you see utilizing that money in different ways?
Definitely, yeah. It depends on what the need is for the funds. So say you need a specific dollar amount just to purchase an investment property. Say you want to purchase an investment property and you're not going to need any additional funds. The house is turnkey, it's ready to rent out. It's $100,000 just for not many properties that cheap, but say it's $200,000, which is a little more realistic. You take out that amount of funds and you're not going to need anything additional. You already know that. You want the slightly lower interest rate that you would get from a HE loan versus a HELOC. That would be an ideal client for that.
For sure. Okay. And then what's the terms to pay it back? Like, you get a HE loan, you buy an investment property. Like, how long after do you have to make your first payment typically? Like, when you get a HE loan?
Yeah, the first payment's going to be the same for really any kind of mortgage program.
Okay.
It's usually within 30 to 45 days.
Okay. And then with HELOC, same thing.
Mm-hmm.
Okay. Interesting.
Yeah.
All right.
The other difference too is that a lot of HELOCs are interest-only payments during the draw period.
Okay.
So that would just be that you have no principal payment, so you're just paying the interest as a requirement. Most will allow you to pay more than the interest only if you wanted to, but it kind of just gives you a little bit more flexibility to have the lowest payment possible.
For sure. Okay. I was going to ask why. Why would they be interest only in the beginning?
It's just a benefit to the borrower.
Yeah, I
Just
figured.
a lower payment.
Figured. Okay, cool. All right, awesome. So, all right, we kind of glazed over the cash out refinance. When would that make sense?
So cash out refinance would generally make the most sense for someone who, like the example I gave about if they have a first mortgage that has a really small balance and they're looking to take out a lot of funds, it could make more sense because the interest rate is so much lower on a first mortgage than it is on a second mortgage.
Mm-hmm.
So first mortgages right now, 6 to 7.5% on average for conventional, versus HELOCs and HE loans are going to be 8 to 10%. So in that situation, if you have a very small first mortgage, it could make more sense to just do a cash out refinance and pay off that mortgage. Or if you bought in the last 2 years, but somehow do have a large amount of equity, say you just made a huge down payment on your home and your rate's 7 to a 7.5, you could lower your interest rate while taking out cash.
Okay, interesting. What is one of the biggest mistakes you see investors making between those three, like utilizing those three products? What do you see them doing wrong?
As far as investors, the biggest mistake I've seen in the last couple of years is just making bad investments. Just simply buying properties that have no real usability as being a good investment property. They're buying properties that are not cash flowing, or they're turning their departing residences into rental properties that are not cash flowing, or just simply just holding on to a property that is not cash flowing at all and doesn't have a huge likelihood of appreciating much.
Yeah, for sure. Have you seen instances recently where doing either a cash out refinance or a HE loan has worked where the borrower is cash flowing on their investment property? Because really, they're not going to buy the whole house. They're going to have a small mortgage on the house, and then they're going to have their payment for their HELOC, HE loan, whatever. And then they have to get a tenant in there who makes up the difference and a cushion. Like, have you seen that recently?
So as far as when they're utilizing both a first mortgage on the investment property, as well as using a home equity line of credit on, say, their primary residence or a different property they own, and using those both on the home,
tight, right?
It's very tight.
Yeah.
It's very tight. I've seen people who are like breaking even, like between the two. So like, say your HELOC payment is $200 a month and your first mortgage, property taxes and insurance is $1,800, and they're able to rent it out for $2,000 a month. Those instances are somewhat common depending on the area. Or if it's, say, a short-term rental, it'd be a lot more likely, especially if it's in an area where they're actually able to be successful in a short-term rental.
That makes sense.
Then they're able to make it work.
Yeah, for sure. Okay, so if you're going to use those products, you probably want to use the whole amount to buy a property, or buy a property that is the whole amount, so you have no mortgage. is really the way for it to
Yeah.
work the best.
And
All
a
right,
lot
cool.
of those cases too, they're using it as more of a short-term avenue. So like say they're using a home equity line of credit just because they want to be able to make a more competitive offer on investment properties because they would be in terms paying cash in that case. So they can negotiate a better deal. And then a lot of them will do delayed financing basically and pull out a mortgage on that investment property once they get a tenant in there.
Yeah, for sure. I really do love the idea of using your equity in your primary residence to buy another primary residence and make that prior house a rental property. That's actually an idea that I've been floating around, me and my husband. I think that may be one of our next steps, but I think that's just a genius idea.
Oh yeah, and that's honestly my favorite way to use a home equity line of credit.
Yeah.
Is taking out the equity, using it as a down payment on a new home, and then renting out the previous property if it's a good potential rental property.
Yeah, for sure. All right, cool. All right, so let's talk about some other house hacking things that people may not know about. One thing that I have utilized with a conventional loan is if you're buying a property for an elderly parent or a child, you only have to put like 5% down. Is that still a thing?
Oh yeah, and the most common thing I've seen or come across for that is mostly the children option, especially if it's a child that's going to college.
Love that.
Rent it out to all their friends, and you end up basically having a free place for your kid to stay during college.
So could you buy, that brings up a good point. Does it have to be local? Like we're in Charlotte. So does your kid have to go to UNC Charlotte, or could your kid go to like Vanderbilt and you buy a house in Tennessee?
Yeah,
and
it
still,
wouldn't matter.
it doesn't matter where it is. Okay.
As long as the kid is going to be living there as their primary residence and they're on the mortgage, then yeah, it's fine.
Okay, interesting. I did it for a parent, really,
Nice.
an in-law. And she is living in the property and pays me rent. And it works out really well.
Heck yes.
Yeah, for sure. All right, cool. So that's a good way to put a low down payment in and help a family member out, parent out. And then what other house hacking thing? Well, there's house hacking. You can, if you haven't bought a house before, right? You can buy a large house or buy a small multifamily, maybe get an FHA loan.
Even if you have bought a house before.
Okay, so let's talk more about that.
Yeah, so if you wanted to kind of get the lowest monthly payment for yourself as possible, a great way to do it, especially if you're a single person and you're willing to have roommates as well, you could really stack things on top of each other. But the most common way to do it is buying like a duplex, triplex, fourplex, and then renting out the additional units and living in one yourself. As long as you live in one of the units, it would be considered a primary residence and allows you that lower down payment, 5%, versus buying an investment property. Minimum is usually 15 to 20%. So it kind of just gives you that lower down payment, as well as you generally get a lower interest rate because it's considered your primary residence. And then you can rent out the other spaces, lowering your total monthly cost yourself.
So how do, like, obviously I know what a down payment is, and I think most of our listeners know what a down payment is, but I mean, I assume that if you're buying it as your primary and you're house hacking, you're going to have that PMI, private mortgage insurance on there. Okay. So what, are there any other criteria? Like if you buy it as a primary and you put down 5%, like what other criteria come with that? Because I've always thought, all right, you have to put down 20%, even on your primary, unless you're a first-time home buyer. But okay, so let's talk about that.
Yeah, so first-time home buyers, if you're buying like a single unit property, the minimum down payment is only 3.5% for FHA or 3% for conventional. Although I will say for conventional, 3% down, you do need to have quite a high credit score in order to qualify usually. If you're buying an additional property, like you're just simply not a first-time home buyer, then the minimum goes up to 5% for conventional. It's always 3.5% for FHA though. It's a single unit property. Also, something that a lot of people don't realize is that if you have owned homes in the past, but you have not owned a property for the last 3 years, you are then considered a first-time home buyer again. So say you move to a new city, you decide to rent for a while, and you just don't get around to buying a house for 3 years, you are now a first-time home buyer again.
If you don't buy a house for 3 years, a primary resident for 3 years, you're considered a first-time home buyer?
As long as you haven't owned any properties for 3 years.
As long as you haven't owned any properties for 3 years. Okay, cool. Interesting.
Yeah,
All
so
right.
it's a little easier to get in the door than a lot of people realize. And there's so many different avenues that people don't consider, is that like the easiest one for a lot of people in this market because, you know, the economy is difficult for people to be saving right now. A lot of people don't know that you can look for down payment assistance programs, which a lot of them are not that great, but there are some good ones out there. But mainly what I did personally and my husband to buy both of our first houses is took out of our 401ks.
Oh, okay. Yeah, there's new rules around that, right? Isn't there new?
There's limits. It's still 10,000. So you can take out 10,000 without the early withdrawal penalty. You do still have to pay property tax, or sorry, not property taxes. You do still have to pay income taxes on it, but you don't have to pay that early withdrawal fee if it's your first home and it's used for down payment.
Got it. Up to $10,000 out of your 401k.
Yeah.
Okay, that's interesting.
Yeah.
All right. Well, that brings up a good point. So what other creative ways have you seen people utilize money like that they may already have and don't really know?
That's definitely the most common. I would say another avenue that is like not as common, but I have personally utilized this in the past, is you can technically pull a loan out of a car if you have a car paid off. So say you are some lucky son of a gun and your family member gave you a car that's paid off, say you inherited it from your grandparents or something like that, or your parents just bought you a car that's paid off and it's, you know, worth 20,000 plus and you don't have a loan on it, you can pull money out of a car and that can be used as a down payment. Or you can pull money out of like investing. If you were someone who happened to invest in stocks and bonds, you can pull money out of that. So really it's just a matter of having some kind of asset to pull from.
For sure. So if you're pulling from like stocks and bonds, would that be like a margin loan kind of thing that you would be pulling?
It depends on the way that it's invested. There are certain options with like some of the larger firms that would allow you to take it out as like a loan, but most of the time it's just straight up cashing out.
Okay. Wow, the car, taking a loan out on a car that's fully paid off. That's interesting. Never really thought about that.
Yep, I've done that when I was in my early 20s to pay off some high interest credit card debt.
Wow. Okay.
Got a much lower rate on the car.
Wow. All right. That's awesome. All right. What other kind of house hacking type things have you seen recently?
Another one is, depending on the area and the zoning requirements, is doing like a small, like a tiny home on your land.
Okay.
And then renting it out as like a short-term rental or even a long-term rental. Say you have a property that's, you know, half an acre to an acre and you have like massive backyard or massive side yard or something. You can put a little 20 by 20 tiny home on it and get some really good cash flow.
Yeah, I love that idea too.
Or if you have like a ADU, which is an additional dwelling unit. Say you have like a above garage apartment, you could always rent that out. Or if you have like a finished basement with a separate entrance, that could be a good way to make some cash flow.
Okay. All right. And I kind of skipped over this because I didn't really think about it until now because I'm thinking about other ways to get money. But doing a HELOC or HE loan on an investment property.
Oh, yeah.
What is that process like?
Oh, it's basically the same. And there's another thing that's super fascinating to me in particular, because I work with a lot of self-employed borrowers, is that there are some new HELOC programs that came out just in the last 6 months that now are allowing us to use bank statement income to qualify, including on investment properties. So that's homeowners and home buyers. I know we're not going to get too far into the non-QM, but if it's someone who writes off more than 50% of the income, they might have difficulties qualifying for a traditional HELOC or even a conventional mortgage because on paper they don't make any money because they write off all of their income. Those options are available now where they can use just their monthly deposit averages from their business account to qualify rather than their tax returns. And they can also do that on an investment property. So the process is the same for investment properties. HELOCs in general are just going to be a much quicker process usually than a first mortgage because we most often go off of what's called a desktop appraisal, where it's just like an automated value report rather than a full in-depth appraisal.
Okay. And then do you and your company, do you guys do HELOCs and HE loans on investment properties? Okay. Does it have to be in an LLC or does it, I went down this road before and mine are in LLCs. I was told at one point that I have to take it out of an LLC and put it in my personal name in order to do so. Is that a thing or?
Depends on the lender and how
Okay.
traditional of a HELOC it is.
Got it.
If it's a HELOC with a credit union or large bank, more than likely they're not going to let you close in an LLC. If it's the kind that the newer ones, especially where they allow us to use like bank statement income and stuff, those would be fine closing in an LLC.
Okay.
Just depends on how traditional the lender is.
Got it. So you're able to do it in an LLC.
Yep.
All right, guys, that's good to know. I'm almost at that point. I have a property that we have a pretty good amount of equity in, but we refinanced in 2020.
Yep.
So I have a
want to touch that
I have a
first.
2.9 interest rate, but I have a ton of equity in there.
Yep.
So I'm like, all right, what can I do?
You
And
can close in like 2 weeks.
fantastic. Yeah, it's I've talked to lenders, but I guess it was over 6 months ago, maybe even over a year ago, and I just had to jump through so many hoops, and I could not really find a lender who would help me without quit claiming it out of my LLC into my personal name and doing all of these things. I'm like, why is this so hard? Like, I have so much equity in this house, I just want to use it to buy another one.
Yep. And it's mainly just in the last like 6 months, the HELOC programs have been opening up substantially. I think they're not necessarily just for investment opportunities, but I think they're recognizing that mortgages are down as far as like purchases are definitely not as high as they were before COVID. There's not enough houses being built. Business is down overall, so they're looking for different avenues to be more flexible.
Yeah, and make money, right? Like,
Absolutely.
don't make it so hard. Like, people want to use you, kind of pay you interest to take money out. Like, why
Right,
not let
take
them
my
do what they
money.
want to do, right? Goodness. All right, so let's touch on the non-QM products.
Sure.
And let's also define, what does non-QM mean?
So non-QM just stands for non-qualified mortgage.
Okay.
And that generally just means that it is not affiliated with the government in any shape, way, or form as far as the qualifications, the guidelines. It's basically just non-traditional. So conventional mortgages are primarily governed by Fannie Mae and Freddie Mac. Those are like government subsidies. They're not like owned by the government, but they're like associated with the government, and they're basically guaranteeing that they're going to buy the loan from the lenders. And so they all kind of go off of Fannie Mae guidelines primarily. So it's very cut and dry, black and white. Either you qualify or you don't qualify. Some lenders will add like overlays and stuff of their own, but in general, there's like not really any kind of gray area or flexibility. Same with VA and FHA and USDA. Those ones are like straight up government affiliated, and those are all going to have very strict guidelines. They're all going to be based on your taxable income. So if you're W-2, they're going to base entirely on your W-2s. If you're self-employed, they're going to be looking at straight up your tax returns. Versus non-traditional mortgages, I would say the best way to think about non-QM is they are primarily for wishy-washy gray area income, not so much gray area properties.
Okay.
That's one of the biggest misconceptions, is a lot of people think that they're more flexible for the property types, but they are not.
Okay.
It can almost be harder for the property types in a lot of cases.
Got it. So if you're an entrepreneur or if you are a full-time real estate investor, then maybe a non-QM product would be better suited for you.
Absolutely.
And then
Or
it's
if you
based
just don't have a traditional job.
or a traditional job, yeah. And then they're really based more on the performance of the property. So it's based on the rent that you would.
Yeah, when it comes to investment properties in particular, they are going to be based almost entirely on the investment property themselves and your credit score and assets. Those are the main criteria. Is the property performing or likely to perform? Do you have a good FICO score? And do you have assets for reserves? Those are the biggest three. I will say though, if you have a massive amount of equity and you're looking at like a cash out, that can be used for reserves. So some of it's flexible. The biggest thing though is credit score for sure.
What's the minimum credit score?
I would say for non-QM, anything below 680 is going to be rough.
Yeah. Okay.
Yeah.
Cool. I mean, that's pretty doable.
Yeah.
All right. Cool. And then what kind of assets are you looking for? Like other rental properties, IRAs, 401ks? You're just looking at all things like that.
So assets, as far as for reserves, it's almost always going to be dollars.
Okay.
Assets don't unfortunately mean really anything for reserves. Like and that's something that is hard for a lot of people to wrap their head around. If they have a bunch of rental properties with a ton of equity, they're like, shouldn't that be taken into consideration? But no lender I've ever seen has ever taken that into consideration. They only look at dollar amounts.
So cash reserves?
Yes, cash reserves, but also investments can be okay as long as it's dollar investments like stocks, bonds, retirement accounts. Those all can work for reserves. Just got to be basically dollars.
Okay. And is there a percentage? Like if you're buying a $250,000 investment property, what kind of cash reserves are you looking for someone to have?
Depends on the program. The minimum is usually 6 months, though. They're looking at 6 months principal, interest, taxes, and insurance for the property you're buying.
Okay. Cool. All right. So then let's just touch on what are the biggest non-QM loans products that you're using right now or we're using.
So the most common one that I use for sure is bank statement loans, or DSCR loans would be the most common for investors.
Okay. And then, all right, cool. And then just break down what a DSCR is in simple terms for people that don't know. Although I feel like most of you know, we've said that so many times.
Yeah. The DSCR stands for debt service coverage ratio, and what it is they're looking at the ratio between how much the property is likely to rent for versus what the monthly principal, interest, taxes, insurance, and HOA if there is one. So if you have a total monthly payment including taxes and insurance and HOA of $2,000, and the likelihood is that the property will rent for $2,000 or it's currently being leased for $2,000, that would be a ratio of 1-to-1. If it's above a ratio of 1-to-1, that means you are cash flowing, and that is generally going to give you more favorable terms. If you're below a ratio of 1, which means you're negative cash flowing, that's going to be less favorable terms.
Yeah. So like 1.25 is kind of like a magic number that I've kind of heard thrown out there.
It's ideal for sure.
Ideal. Yeah. Best rates.
Yeah. The only time you really see above 1.25 is short-term rentals.
Yeah, for sure. All right, cool. So, all right. So give me then a scenario of when you would use or investor that would use a non-QM versus traditional. And say they do have a regular W-2 job, because I feel like the reason you do non-QM is because you don't have a regular job. And you have
in some cases, not always though.
Okay.
So if it's somebody who happens to say it's somebody who straight up qualifies for both, but they really, really, really want to close in an LLC, that would be a good instance where they would go with a DSCR loan, because most conventional mortgages, well, really all conventional mortgages will not allow you to close in an LLC. Some lenders won't throw a pickle if you were to quit claim into an LLC after closing. Most of them don't really notice, but it's still a risk nonetheless, because it's not something that they're straight up saying they're allowed to do. So that could be a good instance of when to close in a DSCR loan. There are some specific scenarios where the rate's actually lower for a DSCR loan than it is for a conventional mortgage, especially if it has that high ratio for the cash flow. And the person has a high credit score. So say someone has a 780 FICO score and the property is likely to have a 1.25 ratio, that might be a better interest rate for a DSCR loan than it would be for conventional. Or if it's a scenario where they're a W-2 employee, but they really don't have a great amount of income, like their income is kind of like just not really quite enough to qualify for the purchase of the investment property, because with conventional mortgages we are only allowed to use 75% of the rent versus DSCR loans. That's a whole different scenario. So that 75% can make it, not quite enough for them to qualify with their income. And that might be someone who would flip to a DSCR. So
realistically, if you are buying an investment property and you're not house hacking, it's not going to be your primary residence. How much of a down payment is realistically, are you going to need to bring to the table?
20%, I would say.
Yeah.
For conventional mortgages, the minimum down payment is 15%. But in a lot of cases, when you run the pricing for the interest rate and costs for the loan, for 15 versus 20%, most people are going to want to go with 20% because it's so much more favorable.
Yeah, for sure. And then you brought up quit claims or quit claiming from your personal name to an LLC. As a lender, how often have you seen the bank or the lender call the due on sale clause on a loan if someone was to transfer a loan from their personal name to an LLC or vice versa? Like, how common is that? I know it's a risk, and that's the disclaimer that I always give, but like, how common is that really?
I've never actually seen it.
I've heard that from so many people, attorneys, lenders.
Never actually seen anybody get in trouble with a quick claim. It's more one of those like myths you hear. Well, not necessarily myth, because it could absolutely happen. It's just, it's not something you really ever hear about. Maybe like if you look up on the internet, you'll find people for sure. And maybe that's like 1 in 1,000 people who get called for it. I feel like it's usually not something that a lender would really red flag for, because lenders just want to keep earning interest, and they know that if they throw a fight about something, the borrower is likely going to refinance somewhere else, sell the house, do something to where that they're not going to have that loan anymore in their books. And so it's more to the lender's benefit to kind of turn a blind eye to it.
Yeah, they're getting their monthly payments. Why would they care?
Exactly. But if there's a scenario where maybe it was a less favorable loan for them to begin with, has a high loan to value, the borrower has a low credit score, they're trying to get that loan off their books and they're struggling to, then they might start looking at things a little bit more in detail.
True.
Situations like that.
True. Yeah. And then I would imagine, like, even if you buy it in your name and then you create an LLC and you're the sole member, like, the bank would look at that and be like, okay, they just put it from their name into an LLC or transferring it into an estate. Like,
yeah, they might be more willing to look the other way in situations like that. I think they would probably be less happy. You're right. If it was like an LLC where you have like 10 members or something.
Yeah. Or completely different people than the original borrower.
Yes.
I get that. And especially if it's like 2%, 3% interest rate and they see like, I transfer it to you.
Probably another scenario.
That's one.
The really low interest rates.
Yeah. For sure.
They don't have as much
they don't want that.
to keep those.
No, they're definitely going to call that. Why wouldn't they? Okay. So what else haven't we talked about that you want to tell our listeners that we haven't touched on? Like anything creative, any kind of tips or tricks for investors and acquiring properties at this time, like this in this world right now?
Yeah, I would say in this market in particular, something that you're well aware of is that investing in rental properties is not a get-rich-quick thing. It's definitely, you have to be way more strategic. You have to be way more knowledgeable and do your research and do your due diligence. I see far too many people who are wanting to buy investment properties that are not great investments. The biggest thing as well is finding a real estate agent who actually knows what they're talking about when it comes to an investment property. I see a lot of home buyers, unfortunately, using real estate agents who don't know anything about being an investor or owning rental properties, and they're advising people to buy properties that don't even come close to cash flowing, and it doesn't really make sense. Like they're looking at the price of the house and whether the house is worth it, and that's all they're looking at, versus it's just not a good rental property. For instance, like if you're looking at properties that are 300 plus, that's when you need to take a way bigger look in detail and making sure this is a good investment.
100%, because you're not getting, the 1% rule really does not apply. If you're buying a $300,000 townhome, which is really what these new construction townhomes are going for right now, you're maybe bringing in $2,000 a month on rent.
Not to mention you're going to have an HOA.
You're going to have an HOA,
That's
for
the
sure.
other thing for sure. It's like, I'm sure you're familiar with this, is buying a house to use as a rental property with an HOA is almost always going to be a no-no. Like, unless it's like, really the good way to think about it is the more expensive the HOA is, the less ideal it is for an investment property, not just simply for the extra cash per month, but the more expensive an HOA is, the more restrictions there usually are.
Oh, for sure.
So
and sometimes they won't even let you have a rental property.
Exactly. And that's something that people need to go into the scenario and be knowledgeable about, especially if they're planning on doing what we would say is a really good idea a lot of the times, is just the continually flipping your primary residences. If you're going into a property planning to move to a different primary residence in 2 years and renting out that one, you need to find out, can I even make this a rental property in 2 years if I wanted to? So it's just a lot more research is required, especially with how tight the numbers are, and maybe looking at different areas that are outside of your general familiarity. So if you're in inner city Charlotte and you live in like Plaza Midwood, probably not the best place to be buying
Probably not the best place.
properties. Maybe you should be looking up in Concord or somewhere that has, less than 300K properties, or getting more hands-on with like fixing up a property, buying a house that's a bit more outdated and needs all the flooring replaced. That might be a better bet than buying a turnkey. So just putting a little bit more effort into it is required in this market.
I agree. And I have a bunch of those available right now, listeners. So reach out if you're looking for something like that. Although, interesting that you say that with a turnkey. I have found recently, and I've said this before, but the investors that are out there now are either looking for super distressed, like need to flip this, gonna burr it, do something
Savvy.
like that. They're looking for distress, like take it down to the studs and redo it. Or they're looking for new construction. It's interesting. I don't know if you've also seen this, but like the cash flowing, middle of the ground, partially renovated, but making money, but maybe built in 1940, 1950, eventually going to need some capital improvements. That group of homes right now, I feel like has been struggling. I don't know if you have noticed the same. And if anyone's out there listening looking for just that, let me know. But have you seen that going on?
Not necessarily in particular. I mean, I guess, yeah. I mean, I feel like all the investors I've been coming across are looking to mostly rehab properties or buying properties that are super distressed. I am seeing a lot of that, like more distressed probably than 2 years ago. That is something that is common. As far as the properties that are middle of the ground, 1960s to 2000s that are in good condition, there's just not a lot of them. There's just not, those types of houses are usually going to go the quickest for primary residence buyers.
True.
And so there's just not a ton of that kind of inventory. As far as the new construction houses, yes, I feel like that is becoming more common. I have a good friend who builds houses, and they have rearranged their business model to where they're offering properties at different tiers. So they're offering like an investment level property that's going to be like the cheapest option, and it's going to have like the lowest quality finishes. Everything's like, it's going to be beautiful and nice, but it's going to be more durable. So it's going to be like LVP flooring, something that's going to be like very easy to keep clean, easy to last a long time, no carpet, versus like the middle layer, you might have more carpet in the bedrooms, things like that for someone who's buying as a primary residence. And then there's going to be like the top end layer where it's going to be definitely a primary residence buyer or maybe a short-term rental. And it's someone who's going to want, the highest end finishes. So it is more common for sure to have I think the reason why we're seeing more new builds for investors is just simply because of the lack of inventory.
Or the ease. Like people don't want to deal with the things that come up, the plumbing things that are inevitably are going to come up in a 1930s house. They're going to happen. The crawl space is probably going to need to be completely redone. There's probably piers under the house that are going to need to be fixed. And I think a lot of investors right now, I think the margins are so tight. They're like, I don't have $20,000 in reserves to fix the roof if it needs to be, fix the crawl space if it needs to be. If the plumbing line collapses, I don't have that money. So I think that's the fear when they buy this new construction. They're like, awesome. I don't have to do anything. It's definitely a different risk tolerance. Okay. So one other thing I wanted to ask you before we start to kind of wrap up, but you mentioned that you've seen like real estate agents bringing you these bad deals with your borrowers. Do you tell the borrowers, hey, this isn't a good deal. Like, let's look for something else. Maybe this is what you should tell your real estate agent that you should be looking for.
The hard part is that a lot of them are being referred to me directly from the real estate agent. So I have to be like very careful in the way that I phrase things to not like shoot myself in the foot with that relationship with the real estate agent. In those instances, I lean less heavy on the advice portion because I want to kind of stay in my own lane as far as like, I don't want to like burn the relationship with the real estate agent. In those situations, I just lean more heavily on the numbers.
Yeah, for sure.
Like if I tell you that the property is going to be $2,000 a month for the principal, interest, taxes, and insurance and HOA, I will simply ask the real estate agent, how much do you think that this could rent for? If they tell me it's only going to rent for $1,500, I kind of feel like those numbers do the work for me.
Yeah, for sure.
So it's just I lean more heavily on the math.
And that shouldn't even been brought to your desk. But whatever. But so a cool thing that we do that you probably don't know about is I go to different brokerage firms and I teach agents how to make more money by working with investors. So I teach them the things to look for. So that may be helpful for your agents who continually bring you, it's like a gift that you can give them.
I will
like
absolutely bring that up next time one of them.
Instead of like,
you guys need to have her come to your office
yeah,
and give a course.
just come on. Like if y'all want to work with investors, have someone to educate you on how to work with the investors. It'll be easier for everybody. They're doing probably less work. They're more knowledgeable. They can talk to their investors in the same language. So
right. And it's another thing that's important too that we haven't really touched on as much is that it does depend on what the borrower's goal is, the buyer's goal as an investor. Some investors are not necessarily in it for the super short-term cash flow. Some of them might be in it for the outright appreciation. And that is a scenario where they might be willing to break even, not cash flow, or even put $100 in a month to the property because it's a very up-and-coming area.
True.
So that is something that we come across sometimes in certain areas of Charlotte that the values are very likely to go up.
I mean, and honestly, realistically, that's probably how much most people are making buying investment property, especially if you're buying in Charlotte or like this area. Maybe if you're getting up more Kannapolis, China Grove, up to Salisbury, you're making more money per month. But if you're buying a decent house in decent shape, like you're probably really tight, but the appreciation and a little bit of value add is definitely the play there. Okay, so what kind of opportunities are you seeing as a lender coming up within the next year? Like, well, what are you seeing with interest rates? Like, if you had a crystal ball, what would you say is going to happen before the end of the year, market-wise?
Well, the current predictions is that we're unfortunately not going to see any rate drops for the rest of the year.
Dang it.
That's unfortunate news, but
why? Why did they say that?
Because the economy is not doing well. Inflation is significantly higher than we were expecting right now. Basically, in the last year, not to get into any politics or anything, but the politics have absolutely had an impact. Like, I mean, wars and things and prices of everything has just gone up so much in the last year. And that's kind of the biggest factor with the Fed, whether they decide to lower interest rates or increase interest rates, is just based on what inflation is doing. So if inflation is continuing to go up, they could potentially even raise interest rates.
Oh, gosh.
Which let's pray that doesn't happen because that would be horrible. But I foresee them probably staying the same unless something crazy were to happen. I mean, if we somehow had another pandemic, which who knows with this virus thing that's been going around, if it mutates or something happens with it, we could see something crazy happen. That's how rates got so low to begin with, was because of COVID. So
for sure.
Yeah.
And then like market-wise, inventory-wise, like where are we? Buyer market, seller market, what are you seeing?
I would say it's pretty much been the same for the last about 2 years. The market has not really changed much. It's been more leaning towards the buyer's market, but not super heavily. I would say Charlotte's pretty healthy compared to a lot of areas of the country. We still have a decent amount of inventory. We have a decent amount of new homes being built, that it's not like a total buyer's market, but you can get really good deals. And in this kind of market, now more than ever, it is very important to have a real estate agent who works hard to negotiate for you, and maybe even a lender as well that can help with the numbers and running things, because I'm seeing clients get really good deals when we get creative as far as how the offer is made. Like you're going to have a much better scenario if you were to negotiate a $15,000 seller credit than you would if you asked for $15,000 less on the price.
Oh, for sure.
So it's just getting more creative and making sure that you're getting a good deal. There's definitely good deals to be had, though.
Yeah, I've been all about those seller credits lately and all my deals. I'm like, how much can you give us?
Yes, let's
get the cash to closing.
Sometimes it even means going over the purchase price too.
Exactly.
Especially if it's a hot property.
Yeah, you just got to put that in your negotiations.
So
exactly. Why not? All right, awesome. All right, so we're up to our 5-minute fast fire session.
Let's do it.
It's one of my favorite parts. It's quick. I'm going to ask you 5 questions. We got a buzzer. So 5 minutes. I'm going to ask you 5 questions, answer them quick. Don't even really like think about it, and we'll go through, and maybe I'll even ask you some bonus questions. Okay. All right. What's one myth about lending that you wish would disappear?
Somehow, I don't know how this myth is still around, is that you need 20% down payment to buy any property, even if you have bought a property before or haven't bought a property before.
I think that's a huge myth.
I don't know. I don't know where the myth came from, honestly. Maybe Dave Ramsey.
I was going to say that
for a while that you should have 20% down. That's one that I wish would die for sure.
Mm-hmm. Yep, I would definitely agree with that. What's more important, a credit score or cash reserves?
Credit score.
Ah,
Absolutely.
okay.
Credit is highly underrated. And a lot of borrowers don't understand how much of an impact it can have. If there's something you can do to get your credit score from a 680 to a 720, that can be a huge difference depending on the scenario. More so with conventional mortgages especially. That is another thing people don't realize, is that FHA mortgages, your credit score is a lot less important than it is with a conventional mortgage. But yeah, getting your credit score from a 680 to a 720 can be very impactful, especially if you're using a DSCR loan.
Yes. We can talk about it later. All right. What's your favorite real estate or business book?
I have never actually read a real estate or business book.
Oh, really?
Mm-mm.
Never read Rich Dad Poor Dad?
No.
Or,
Mm-mm.
oh, wow. That's a good one for you.
It could be, yeah. I'm not much of a reader. I don't like reading.
Okay. Well, then I was going to ask you, what book are you reading right now?
I do not read.
You don't read. You listen to podcasts?
I listen to a lot of podcasts and a lot of audiobooks for sure.
Okay.
I've never listened to any real estate audiobooks. This is going to sound crazy because I am a mortgage broker and I've worked in finance basically my whole life, but I don't find finance super interesting as far as like in my downtime. Like, I'm super knowledgeable about it, mainly from practice.
Okay.
Just from actually like having to find things out and having to learn things. I enjoy talking about it and like conversating with people about it and maybe hearing a little bit of the differences and stuff, but I don't find it super fascinating to like full on listen to books.
Yeah, if that's what you went to school for and that's what you've been doing as a job, then I would imagine that in your downtime you don't want to continue reading that.
Yeah. So like the book I'm listening to right now is about law of attraction.
Oh, okay. Well, that's fun. I love that too. I love all the
Which
psychology
all
stuff like
comes
that.
together.
100%. All right. What is the best piece of financial advice you've ever received?
I would say the best piece of financial advice I've ever received comes back to credit score. It's just my parents instilling me from a very young age how deeply important it is to have as high of a credit score as you possibly can, and utilizing credit in a responsible way that you can make it work for you rather than against you. So there's many ways with credit that you can make money from credit, or just having your credit score as high as possible to get the best approvals and the best terms. And there are smart ways you can go about it too, as far as taking his advice and not using credit, but also using credit. Like, say you just instead of cutting up and closing all your credit cards, just keep your subscriptions on them or something.
Yeah.
Keep them going. Don't use your credit card for your general expenses and purchases and stuff. Just, have a subscription on each card to keep it open.
For sure. Dave Ramsey, we love you, but we just sometimes disagree with some of the things that you say.
Yeah,
but, it's all good.
Manual underwriting is not a fun process, and you're going to get a worse rate.
It's all good. Okay. I think last question. I think this is number 5.
Mm-hmm.
All right. What's one financing strategy you wish more investors knew about?
I would say financial strategy that I wish more investors utilize more often is the flipping primary residences.
Oh yeah, I want to do that.
I feel like a lot of people just don't really do that enough. Their main focus is just buying a primary residence for them to buy a primary residence, and then they want to buy investment properties after that. And it's so much smarter if you just continue flipping primary residences, because you're going to get the lowest interest rate because it's a primary. You're also going to get the lowest down payment, 5% max versus 20%. Like, it's just a way better financial strategy long term.
I think you've talked me into it.
Next primary.
I think I'm gonna do it. My husband's really been wanting a house with a pool, so I'm like, that doesn't sound too bad. We go on less.
That could be an Airbnb.
We'll go on less vacations.
There you go.
All right. So this has been awesome. You have given our listeners a wealth of knowledge, things for people to think about. So how can people connect with you?
You can always call me or text me. My phone number is 503-553-9028. Or you can find me on Instagram is where I'm at most often with social media. And it's just Reanna_mortgages. So REANNA_mortgages. And that's as simple as it gets.
Easy peasy. Or you can just reach out to me and I'll connect you with her. Either way works. Awesome, guys. So if you were listening to this and you were like, all right, I need to get more information. This is what I need to do. And it really lit a fire. Give us a call, shoot me an email, go to branchwealthpartners.com. My email's on there. Reach out. I will connect you with whoever you need to be connected with, help you in any way that I can. But thank you for watching. Talk to you guys soon.